behind us? Is there more turbulence ahead? Let's find out. Market expert Ajay Bagga is with us to break this down. But before I do that, I want your first take on this. Ajay, is it time to hold on to cash still or get back skin in the game?
I think we can hold on existing investments. Vikram, there are two divergent options in
Yes.
front of us. If this was just a correction, a 10-15% correction, then we are mostly through. And we have had 4 months of, or rather now 5 months of quite intense pain. So hopefully we are through with it. Though the mid cap is just teetering on the brink of a bear market, and small caps have already lost 21 to 23% at various indices level. And stocks have lost 30 to even 50% in some cases. So if it was just in a structural bull market, it was just a correction which happens every year, then we are mostly through. I think the problem is a little deeper. And if you see this as the start of a fresh bear market, then that takes about 12 months on average. If you see right from 91, post Harshad scam breaking to now, the biggest bear market was 94 to 97, about 2.5 years. Then the second biggest was the dot-com crash globally. But overall, we have seen much shallower bear markets, and in about 12 months, we see that most of the damage gets done. If we are there, then it's another 7 months more, and you could see 5 to 10% more correction on the leading indices. Already mid and small cap are on the brink of a bear market, if not reached a bear market. Now, coming to the economy, my personal thinking is that come September quarter, we would have seen some kind of recovery coming in, and markets will normally move in anticipation.
Yes.
So around June, if our thesis is right of a September uptick coming in, then around June the markets would have started taking position. So a lot of uncertainty, Vikram, because of the global and domestic, because fiscally you have pulled out 40 basis points from the fiscal stimulus, gone down from 4.8 to 4.4. Monetarily, we are behind the curve. We should have had much lower rates. Real rates are high, and industry is frankly not borrowing. So the third option then was reform stimulus, which is frankly lacking in the economy. Then what comes out is some external flow coming in, which raises the valuation, which is not happening, because even at Vikram 2027 financial year end, we are looking at about 1340 rupees, 1350 rupees Nifty EPS.
Right.
That gives you a 27,000 Nifty target starting, say, early next year when you discount 1 year ahead. So
Yes.
26,000 doable, but the path will be full of a lot of more corrections is what I feel.
So when I'm reading that equity mutual funds, and there is data to support this as well, they're keeping a sizable amount of cash on the sidelines, despite valuations, according to at least these brokerages, becoming more reasonable. Does it indicate that fund managers are also as unsure as you're sounding about the direction that the markets are likely to take, and the uncertainties are only too obvious? A lot of it is global factors?
Yeah, a lot of, I would agree there because, the FPI selling is just not reducing, and you're not seeing a catalyst. So two catalysts would be there. A, if there is a sharp correction, if we reach a 21,000 kind of level, then you're home. I would say then take loans on houses and get into the market on a 2-year basis. You will make a lot of money on a broad index sense. We are not getting there. What we are seeing is a very tight band where there are buyers and sellers at both ends. So there are buyers who come in as the market approaches that 22,800 levels. We see buying coming back, and then as it tries to break through, on the top there are huge amounts of sellers sitting at every level. So this points to a very tight, coiled kind of market, Vikram. It can go one way based on event risk. Say Ukraine happens and oil prices crash, that could give you a temporary reprieve. But overall, I think next another 6-7 months of pain have to be gone through, maybe another 5 to 10% on the leading indices and maybe a 10% more on the broader indices on the SMIDs coming through.
So, Ajay, when mutual funds, they've been holding around 4.8% of their assets under management in cash, and this for the past 6 months. And some see this at least as a contrarian signal that a market bottom could be forming. Do you agree with that interpretation at all?
Uh, the fundamentals are not showing that, Vikram, because your earnings are not really this year. The coming year, FY 2026, we are looking at 1150, 1160 kind of earnings, going to 1340, 1350 kind of earnings. So earnings are not justifying the index levels. That is the big problem, the macro trouble sitting in the room. Until we solve for that, and that will happen I think by September, as earnings start picking up and there are re-ratings upwards, in anticipation of that, you could see moves coming in by June, July. Or if we sink below that 20%, then September will probably give you that 12 months average bear market. And then it will start picking up in October with the festive season. Those are the two broad themes. But for really picking up, you need earnings to recover, which are not happening, or you need huge flows globally, which are happy with these 10, 12, 14% kind of earnings, and they start coming in. That is also not happening. With China at a huge discount to the Indian markets, there were outflows in China, but what has happened is the monetization of Chinese tech is on. And Xi Jinping did a very smart move in meeting the tech leaders earlier this week. And what that has led to is very strong growth in the Hang Seng Tech Index and the Chinese tech indices. So the monetization of Chinese tech has led the Chinese markets higher, though they have the issue of demographics, they have the issue of deflation, and they have the issue of deleveraging of a massive property bubble, which has still not delivered. Those bears are sitting in the room, but the Chinese monetization of technology has taken their markets higher. And now with Goldman Sachs and other brokerages calling that China should continue doing well, we are seeing flows getting diverted to China, which is negative India to some extent.
But I was just looking at the 5-year Shanghai chart. The index is suggesting that over the last 5 years, the returns haven't been very high. Over the last 5 years, it's been pretty flat. So how do you explain that conundrum? Why do you say that a lot more money is going towards China?
Because today the valuations are so compelling that you can't lose money. Second, the technology monetization that is happening with the likes of Alibaba's and all coming through with their AI models. These are the two factors. As I said, deflation, demographics, and deleveraging. That has not worked for China, and that's the 5-10 years underperformance of their markets. They are bringing in a stabilization fund for stocks. The government companies are coming in and buying up stocks. They are encouraging fund managers to buy stocks. Xi has changed his 4-year policy of common prosperity. Again, he is shaking hands with the top corporates, Vikram. That is a very big symbolism. And China thrives on this kind of symbolism. He's really showing that that cutting edge technology which Chinese companies are delivering, we are standing by you. And markets are now assuming that means that they are back in favor and we can invest in them. So it's not on the last 5 years performance. You would not touch China. Even first week of February, we saw $5 billion coming out of China funds and global China funds. But last 10 days, what is happening, especially after DeepSeek, Vikram,
Yes.
there is a big re-rating of the China tech sector.
Right. So in contrast then, how is India being able to reassure investors? Because the kind of outflows that we've seen, and I was asking and having a discussion about this with our expert yesterday as well, Sunil Subramaniam was on the show, and he believes that these kind of outflows, like the finance minister is saying, there could be a certain amount of profit booking that the FIIs have done. But I was asking, why book profits right now? Aren't you looking into the future, like you're suggesting about China? Isn't that what FIIs also looking at when it comes to India? Because you've spoken consistently about the structural India story, and that you've said remains intact.
That remains intact, but if you're getting 20, 21 one-year forward PE versus 9 one-year forward PE, and you're getting AI in that, that's the kind of thing that's working. Latin American funds have seen outflows. Only emerging market funds that are really seeing outflows are either inflows are either the frontiers who are too small. Serious money is not really going, but frontiers are doing very well. Frontier countries and Eastern Europe. Eastern Europe on the Ukraine resolution, we are seeing a lot of funds going into Eastern Europe. We have seen money going into Germany, but coming out of France, because France has a debt issue. You have seen the bond yields, what they are telling you. UK has a gilt yield issue, which is worse than what Truss, when the crisis with Liz Truss. Yeah. So not so much money in UK, but Germany, which is underperforming as an economy, is up 13% this year. China is up 30%. And largely on the back of this monetization of technology.
The monetization
funds
of technology.
Are really looking, Vikram, at the cheapest growth stories you can get. India is an expensive growth story. They are saying we'll weight it, and of course, 800 billion stays put. You are losing about 20 billion a year, which is okay. But it's not letting your market progress. And the big issue is valuations. So unless your earnings grow.
It's an expensive growth story, and that's an important takeaway. So what do you tell retail investors right now watching this correction nervously? Ajay, what's your message to them? Buy selectively or wait for clearer signs of recovery? And for those who have fresh capital, what's the best approach? Should they deploy aggressively at current levels? Again, wait for more clarity over the next few months.
I think wait for clarity. If it's a bad news by September, we should have bottomed out. You will find those levels of 21,000 or maybe lower than that. That's the worst case scenario of everything going wrong. I don't think that will go wrong so much. So again, if the professional fund managers are so dichotomous, they are not very clear, they are holding cash. I don't think we should blame the retail investors. Right now, you're getting good returns in fixed income. That's one option. You can lock that in, and rates will go down. My personal thinking is at least 50 to 75 basis points of rate cuts in India will happen this year. So you will make returns on debt assets. That is one. Secondly, on equities, I would go more selective, Vikram. I would agree with you. I think the indices might not do anything for a large part of this year. But if you can't pick the sector stocks, then buy the index and keep buying regularly. So just divide your money by 12, the fresh allocations, and allocate across. But that 12 months period is looking quite strong. We don't see an Asian financial crisis kind of a 97 or a 2008 kind of an event hitting us. Only thing is, if Trump does a massive tariff boost, which is mostly not happening. It's not in the probability scenarios for most fund managers, most investors, most governments. Yes. All know that Trump will shock, Trump will then deal and negotiate for a good deal. So we are in the shock period of Trump. April 1, the negotiation starts, and hopefully by May, we get deals where then you could see a global relief rally again coming in. So right now, markets have not factored in Trump fully. Right. And if worst case scenarios come in, then you could see a lot of global flows retreating. Yes. Overall, Vikram, last 2 weeks, money has gone out of global equities. Right. Money is going out of Japan. Money is going out of France. Most of LATAM, most of emerging markets. Even outperforming market like Brazil has seen money going out. A lot of money going into gold and silver, especially physical gold funds are attracting a lot of money. And if you're domiciled in US, those are very attractive funds. Somehow a lot of physical gold is being shipped from Bank of England into New York vaults.
And we were
So
talking about
that's
that just a moment, not too long ago, and that's something that we are watching very closely as well. But, you know, from the kind of shocks that Trump could deliver to the global economy and including our own, but as far as the real India story, the growth story, you say it's an expensive one. So monetization of technology is something that China is doing well. Whether India can actually rise to the challenge, that's something we have to watch. Fiscal support to corporate capex, steady domestic inflows. There are enough levers out there to pull the market back up. But as always, caution and strategy are going to be key. Ajay Bagga, always a pleasure having you on the show. Thank you so much for joining us with your insights on India Tonight.
excellent.
Another quick break, after which we talk about US and Russia. They have met in